Asia was booming, then everything collapsed overnight. One moment they were unstoppable, the next, everything was falling apart. But before we get started, make sure to like this video and subscribe to the channel so you don't miss any new content. In the early 1990s, Southeast Asia was the envy of the world. Countries like Thailand, Indonesia, and South Korea were celebrated as the Asian tigers, fast-growing economies fueled by exports, foreign investment, and rapid industrialization. Skyscrapers rose, stock markets surged, and currencies appeared stable. Beneath the surface, however, a dangerous imbalance was quietly building. Much of this growth was financed by foreign capital, particularly short-term loans denominated in US dollars. Local banks and corporations borrowed heavily, betting that exchange rates would remain stable. Governments, in turn, maintained fixed or semi-fixed currency pegs to the dollar, creating a sense of security that attracted even more capital inflows. The illusion began to crack in Thailand. By early 1997, Thailand's economy was overheating. Real estate markets were bloated, exports were slowing, and foreign investors began to question whether the Thai baht was overvalued. Currency speculators moved quickly, betting against the baht in massive volumes. The Thai central bank spent billions trying to defend its currency, but ultimately ran out of reserves. In July 1997, Thailand was forced to abandon its currency peg. The baht collapsed almost overnight. What followed was a domino effect across the region, now known as the Asian financial crisis. As confidence evaporated, investors rapidly pulled their money out of neighboring economies. Currencies in Indonesia, Malaysia, and South Korea plunged. Companies that had borrowed in dollars suddenly faced skyrocketing repayment costs as their local currencies weakened. Banks collapsed under the weight of bad loans, and stock markets lost more than half their value in some countries. Indonesia was hit particularly hard. Its rupiah lost over 80% of its value, triggering widespread bankruptcies and social unrest. South Korea, once seen as a model of industrial success, was pushed to the brink of default and required a massive bailout from the International Monetary Fund. At its core, the crisis was not just about speculation, it was about fragile financial systems, excessive foreign debt, and misplaced confidence in fixed exchange rates. Currency speculators didn't create the weaknesses, they exposed them. By the end of 1998, millions had lost jobs, poverty had surged, and the Asian miracle had turned into a cautionary tale. Yet, from the ruins emerged stronger financial systems, tighter regulations, and a renewed focus on economic resilience. The crisis left behind a lasting lesson. Rapid growth without strong financial foundations can collapse just as quickly as it rises.